Thanks for coming to the inaugural kickoff event for the Utah Venture Capital Case Competition. Really excited to be here and to be launching this. We just did this in the spring semester in San Diego. We have an office there, and so we ran it through there and had a ton of fun. And so we're super excited to bring it here to Utah. So agenda-wise, we're going to go through a quick intro to who we are, University Growth Fund. Maybe some of you aren't aware of who we are as a firm. And then we'll talk about the competition, the rules, the schedule, and then we're going to talk a little bit about what is venture capital and a little bit on how to do some deal sourcing so you guys can get started on the first part of the competition. We'll also talk a little bit about some of the deadlines. So we've changed some of the dates. We're giving you a little bit more time to build out your team if you want to bring more people in and join you. And as well as kind of the initial deadlines to get started. So with that, let's dive into it. So University Growth Fund, who are we? So if you're not familiar with us, we're a $32 million fund based in Salt Lake City, Utah. We're not part of any one university. And because of that, we're able to draw students from all the different universities in Utah and San Diego where we have offices. So we have students from BYU, Westminster, USU, UVU, University of Utah, really any student that's interested in participating in our program. Out of our current fund, we made 42 investments, and we've had a number go public or get acquired, particularly this year. So it's been a really exciting year. And we've got 30 to 40 students at any given time in our program. This is just a quick snapshot of the type of deals that we do. So as you can see, it's a pretty broad range of things. We invest in early stage companies that you may not have heard of before, like a good example of that is Blast, that they're kind of a fintech / gaming tech company that's really interesting out of Newport, to more growth stage companies like Lyft. That was the first investment we made out of our fund. They just went public earlier this year. And we even do some kind of later stage deals as well. So like Spotify, when we made that investment, it was about a year and a half before they went public. The company was doing about $1 billion in revenue when we invested. And when they went public, we're doing about $5 billion in revenue. So pretty late stage, but really exciting growth. A little bit about our program. So the thing that we think really differentiates us from every other internship out there is that if you think about pretty much all internship programs, there's what the business does, day to day, day in, day out. That's their core, that's their focus. And then they have an internship program. We're the opposite. Our focus day in, day out, right, is our internship program. So we put the students are the focus of everything. And what changes it from being like a class or a club is that we invest real money. We invest millions of dollars into these companies. And because we invest real money, when we sit down with an entrepreneur, or you as students sit down across the table from an entrepreneur, they have a deeper level of respect for you. And so they'll answer interesting questions about their business and have a much more engaging and deeper conversation with you. And then everything else builds off of that. So we have this unique mentoring environment where our students are mentored not only by myself and my partner, but also by other investors that we're investing alongside. They're mentored by the entrepreneurs. They're mentored by each other. We have a pretty robust training program at all stages of our program. And that then results in terms of really great job opportunities that come to us. If you are at all interested in participating in our program, we'd love to see your application. We will be accepting applications next month. And the tentative resume due date is November 15th, and you can apply through our website. So that's us, that's what we do. And we'll be doing information sessions and other things and talking more about who we are in the future, if that's of interest. So let's talk about the reason you're here, which is the competition. And let me first say, now that you have a little bit of context with who we are, why are we doing this competition? So every year we get hundreds of applications for our program. And as a firm that is purpose-built in a lot of ways to give students world-class experiential education, we would love to accept every student that was interested. Unfortunately, that's just not feasible given the resources we have. And so we've decided that, hey, let's build this venture capital case competition as a way to provide more exposure to what venture capital is, how it works, more training to more students, even those that may not be like super interested in our program, but want broader exposure and opportunity. So that's one reason. And the second reason is we think that we're probably still missing out on some really great candidates who just don't realize that venture capital could be something they would find interesting. Because I think there's this misconception that like venture capital is all finance, hardcore, heavy, digging through Excel spreadsheets, finance. And as you'll learn over the next several sessions, that is not the case. There's a tremendous amount of strategy and predicting markets and understanding consumer behavior and evaluating the competition and what they're doing. And there's a lot of intangibles and so forth that go into it that really make for a great venture capitalist that don't have anything to do, at least at first blush, with income statements and balance sheets. Although eventually all of that information gets kind of boiled down into those numbers. And so we're going to teach you how to do a bunch of that stuff. So that's the reason we're doing this. So with that, I'd love some participation. Let's dive right into some training. What is venture capital? Is it this? What is this? You guys recognize this? Shark Tank, right? Is this venture capital? Yes or no? What do you think? Yes? No? Who are the yeses and why, and who are the no's? Anyone? Who's a yes? Who says yes? Yeah.
Because they're investing in companies that are not public.
Okay. Yes. From a straightforward definition, yeah.
They're investing in companies to help them expand their operation.
Okay. So they're putting capital in to help them grow, right? So they're privately held and they're putting money behind them to grow. Who says no? Yeah. Why?
I'd say no, because they're more angel investors, and they don't really raise a fund. They're just investing their personal money.
That's true. That's true. So they're angel investors. So venture capital, this idea that it's an institution, right, that's making an investment. Why else? Yeah.
A lot of the products aren't very scalable, like they're like actual just products you sell to stores.
Yeah, that's an interesting point. So the types of businesses that they back maybe aren't venture capital type businesses, right? They're not scalable. Yeah.
It's more of a pitch competition because there's no really due diligences into the companies.
Right. There's not a lot of due diligence done. True. And a lot of these companies, they're all across the map, right, in terms of what they do. Some are software, but most are product companies. And a lot of it's just kind of based on their gut, right? Do they take board seats often? Not typically, right? So there's also this whole other layer of governance that's not being captured and that is very typical of venture capital. Any other thoughts? All right, so I think you guys are all right. I think at a fundamental level, though, is that most people think that this is what venture capitalism is like. You sit in your plush chair, entrepreneurs come to you, you ask them hard questions and berate them, and then ultimately decide whether or not to give them, some investment. And that's actually not really what happens in venture capital, as you can imagine. So, venture capital is investments in small companies that have the potential to become huge companies. That is, to me, like the biggest differentiator, as was pointed out, between what people on Shark Tank do and what traditional venture capitalists do, right? VCs are looking for guys like this that are launching companies like that that'll someday go from just this neato idea in the garage, literally, right, to being worth hundreds of billions of dollars someday, right? And what's interesting is it is totally a game of buy low and sell, hopefully super, super high. It is not like a value play like, Warren Buffett or any of those things. It's, we're gonna take a bet on something extremely risky. We're gonna give it some capital and we're gonna take some ownership, and we're gonna hope that they can get to be really, really big. So what does that mean? In order to be a successful venture capitalist, you have to be able to identify what's the next big thing. You have to have the ability to find the company that will win in that space. You have to have the ability to invest in that company, and you have to help that company succeed. Those are the 4 key things of being a venture capitalist. So if we think back to our Shark Tank example, right, there's a handful of these that they don't even do, right? But that also is one of the big differences in terms of what the experience of a day-to-day venture capitalist is like relative to them. So if we go through these, I've got to be able to figure out what's the next big wave, right? Is it going to be something around cryptocurrency? Is it going to be something around self-driving cars? Is it going to be something around alternative types of food? What is that next big wave, right? If you think about the past, it's been, just the last little bit, right? You had search, and then you had social, and then you had both search and social enabled peer-to-peer, right? And that's how you get Uber, right? So you get Google, Facebook, Uber. What's going to be that next mega trend? And then just because I know what that next mega trend is going to be, I then have to go and I got to find the company that's going to win. When Google launched, they weren't the first search engine. Facebook wasn't the first social network, right? There were lots of others that were further ahead, had more funding, more traction, all of those things than any of those companies did. So you got to be able to figure out which one of them is going to ultimately win. The reason why Google wins is because their search algorithm ended up being way better than anybody else's, by like an order of magnitude better. And so that's why they won, even though they were really late to the game. So you got to find the company that's going to win. And then once you've found the company, you have to be able to invest in it, which might seem obvious and easy, but actually isn't. Because oftentimes you're not the only one that's figured out the next mega trend and a company that has a high potential of succeeding in that space. There's usually other VCs, and they're also fighting to get that deal. And so sometimes the opposite can be the case of what you see in Shark Tank, where it's more like the entrepreneur is sitting in the plush chair and is being approached by tons of venture capitalists that fly in and beg him or her to take their investment dollars, right? So you have to have the ability to invest in that company. And then lastly, just because you invested, now you've got to be able to help that company succeed. And there are lots of different ways that VCs do that. Primarily though, they do it by helping the company hire and helping the company raise money and helping the company avoid major pitfalls as they grow, right? So what we're going to try to do with this case competition is, instead of me giving you a case and having you work through the case and submit something, the goal here is to give you the experience of what it takes to be a successful venture capitalist. So in this case competition, you will have to go out and figure out what the next big thing is. What do you think it is? Where are the big trends? Where are things moving? What company do you think is well positioned to take advantage of those trends? And then you're going to have to find a company that's well positioned where you have the ability to invest in it. And then, number 4 is a little bit outside what we're going to do in the competition. But hopefully you should be thinking through, how that company, where the challenges are for that company and where they're going to need help. All right. So the other piece of it is, not only are we going to find diligence, we're also going to add the last piece, which is venture capital firms are institutions, but they are small partnerships. It's a handful of people usually. And these men and women are partners. But what's interesting is even though they're partners, they kind of work by themselves typically as well. So they're almost like an investor by themselves. So it's this interesting dynamic where a partner of a venture fund, they'll go out, they'll find an interesting opportunity that they're super excited about, they'll do their diligence on it, and then they come back to the partnership and they have to convince the rest of the partners to do the deal. And so the way that we're going to replicate that here is we are bringing in some really top tier venture capitalists in our network who will be our judges. And your team, will pitch your investment as though you were one of the partners with them in a fund and try to convince them that this is a really compelling investment opportunity that you should make as a firm. All right, so let's hop into some of the rules. Teams, 2 to 4 people. Any combination of school, major, stage in school, I don't really care. Stack your team as strong as you can. But yeah, 2 to 4 people. We want it to be a team effort because that is also the case in VC. Everything is kind of done in teams. You can source from anywhere, but must be current and you must have access to the financials and other performance metrics. And the data must be verifiable. So that's going to exclude a lot of great companies, frankly, right? And I get that. But there are also a lot of sources out there of companies and information on companies that are really interesting. What I'm really getting at here, it must be current. So you can't be like, Facebook's gonna kill it, like let's invest in Facebook. That's done, that's over, that's in the past, right? You gotta find something new and exciting. And you have to have some level of access to the financials and performance numbers. You don't have to have access to everything and every nook and cranny of the deal with the company, but you have to have enough to make a good investment decision. And then attendance at all the workshops is not required, but it is highly encouraged. We are recording this workshop, so if you have friends that couldn't make it tonight, it'll be recorded and posted on our website. And we will record all of the training sessions. But if you come, then not only will you get to engage with me, but we also have a bunch of our students that will be attending every event. And you can go talk to them and get feedback and mentorship as well. And then later on, we might bring in some additional venture capitalists, kind of also network and mentor as well. So there are advantages and bonuses for coming and attending the events. Other than that, it's kind of free game. So the workshop kickoff is today. Then we're going to have basically 3 more workshops, and then we'll have our VC partner meeting, our final event. Workshop number 2, we're going to touch a little bit on deal sourcing today, but most of that is going to happen next week. And I forgot to update that one date. In fact, I'm just going to skip to the next slide. This slide has all of it. So next week, we'll have our workshop number 2 on deal sourcing. It'll be up at USU. Again, if you can't make the drive all the way up there, it will be recorded. That night, the signups will close. So you have a full week to go out and build out the rest of your team. Get more people to join. And then on the 24th, we'll announce our teams, and then on the 30th, we'll have workshop number 3, which is where we'll do a deep dive into due diligence. So we'll be covering things like how to assess a market and competition. That night, your 3 companies are due. So you need to go out and you need to identify 3 companies you think are really interesting. And then ultimately one of those 3 you'll pick and you'll start diving into due diligence. The reason we want you to pick 3 is because you might pick one of them and start digging into the diligence and find out that the CEO is like been convicted of securities fraud or something like that, which is like a total like kill the deal, right? And we want you to have some backups, so that's why we want you to find three. That workshop will be at Westminster, and then we give you basically 2 weeks to start cranking through diligence. We'll do some more due diligence training on the 13th, as well as a little bit of guidance on how to prepare your presentation. And then the week after that, your investment analysis is due. We'll review all of the analyses. We'll give you, everybody will get feedback on it. And then we will select 5 teams to be the finalists. And we'll pair each one of those teams up with a venture capitalist to be their kind of mentor. And they'll work with them over the next the subsequent 2 weeks to kind of round out any diligence items that need to be rounded out, finalize their deck and polish it, and get it ready for the final event, which will be December 4th. And then the team that wins, so of the 5 finalists, we'll have 3 winners. So the top placing team will receive cash prize of $2,000, plus we'll take them out to dinner someplace really nice here with the judges. So you get kind of very intimate one-on-one type networking opportunity with the judges. And then the second place and third place teams will also receive cash prizes. So that's the structure of the event. I'm going to pause there. Any questions about rules, composition? Yeah?
Yeah, so I wanted to begin with the sign-ups. Is the sign-up going to just be our names, or is there like any requirements that we have to bring with our sign-up?
In terms of like your team?
Like, we have to like submit resumes or anything, or is
No.
everyone who signs up going to get the opportunity?
Everyone that signs up gets the opportunity. Yep. And even if you don't want to participate in the competition, you just want to come and learn, you're welcome to do that too. We want this to be as inclusive as possible, which is why we're not kind of cutting back the teams to the finalists until the very end. We want everybody coming to as many events as possible. Yeah.
What size or kind of companies are you looking for?
That's a good question. So they should be early stage companies. Probably companies that we would consider kind of like Series A or seed stage companies. So probably doing revenue in the 0 to a few $1 million in size. It's a good question. Yeah.
So, pre-seed?
Sure. Pre-seed's fine. Yep. Seed, pre-seed, Series A, all fine. Series B starts to become a stretch. Anything beyond Series B, not a fit. Yeah.
What metrics will you use to choose the winner?
It's going to be a balance of basically how compelling is the opportunity and how good is your diligence. Probably about 50-50 weight on both. So you do really good, the opportunity you found is like, but your diligence is really, really good, right? That's gonna go well for you, and vice versa, right? But if you're weak on both, probably not. Yeah.
Just out of curiosity, do you think that you'll end up using the work from this competition in deal sourcing later on?
Maybe, but that's not an expectation of the competition. So we're not expecting you to go out and source our next deal. But hey, if you go out and you find the next Google and it's really that compelling, like, what, I'm gonna be an idiot and be like, no, it's not. And I'll tell you what, here's the other thing you guys should realize, is that as a venture capitalist, there's kind of this joke in the industry that like, once you've joined a venture fund as like an analyst or associate, if you're not made partner within 2 years, it's probably never going to happen. And that seems crazy, but it totally happens. It's just there are very, very few people it happens to, and the people that it happens to are the ones that find the next Google when they're there during that 2-year time period. Did I see another hand? Yeah.
Are you placing a limit on what resources you can use? Can you use professors?
You can use
et cetera, et
whatever
cetera?
you want, yeah. You can't say that you're with a fund other than the fund that you're with, your little team, right? So you can't say you're part of University Growth Fund, right? But yeah, free game with all of your resources at your disposal. Because that's what the real world is like, right? Yeah.
For the due diligence and presentation, are we expected to present a memo, or is it just a presentation, or is it like an executive summary of a memo?
So your submission will be an investment memo that you submit. What you actually present will just be a presentation that will hit the key highlights and summary of your memo. But we want you writing a full memo because when you're on stage, if you just prepared a really skimpy presentation, the judges are going to drill you, and you're going to want to be prepared. So,
Follow-up question to that.
Yeah.
Will this memo be like a VCIC style like 4-page memo, or will it be like a full like 40-page like creative memo?
It will be whatever you feel is necessary to show that you adequately performed your due diligence. Put it that way. We'll give you some additional guidelines as we get closer, but probably I would err more to the side of 40 pages rather than 4. Any other questions? All right. Well, if you think of more, we will take more time to answer questions as we go along, but then also myself and a bunch of our students will be here to also answer questions. Can I have everyone that's here from University Growth Fund raise their hand real quick? All right, so there you go. Grab one of these people that are raising their hands afterwards, and we can help. All right, I think I hit on all of this. Great. Okay, so let's get into a little bit more training. VC fund economics. All right, how many of you are familiar with the normal distribution? Yeah, the bell curve, right? Here's the funny thing about venture capital. A lot of people think the bell curve applies to venture capital, which is, well, there's like a Google or Facebook way out here, right? And there's you lose all your money on a few deals, but most deals, you kind of make like an okay return, right? That's actually not the case in venture capital. In venture capital, it's what we call the power law distribution, which is, if you've heard of the 80-20 rule, right? Kind of applies here, where 80% of the returns or the productivity or whatever is generated by 20% of the people. Same basic idea here. You have Google that returns a massive amount of capital to its investors. And then you have the next deal and it's a huge drop. And then the next deal and a huge drop and a huge drop and a huge drop all the way down. And then right around here, this is everybody's just losing money. In fact, actually the power law, if the axes were returns back to investors, right, on deals, it actually would go negative really fast. The other thing is it also holds true for venture funds. So not just on an individual basis, but on the funds themselves, which are, if you think about the fund, it's an aggregate of deals. But what kind of return does my one winner need to have in order to be able to raise another fund? What do you think? In order to generate enough profits for my investors that I get them excited about my next deal, my next fund. What do you think? Yeah.
You need at least 100 million. You need to
I haven't even returned my fund yet, right? I invested 100 million and so far I've only returned 90.
turned 90 lost money on
So far I've lost money. I've got one deal left. How much does that deal need to return? 10. So I need to just give the money back and I'm good. My investors will give me another 100 million to invest next year. Probably not, right? Probably more. How much more? Yeah?
To cover your losses, you need at least 30 million, but to make it so you're actually making something, you want like 60 or 70
60 or 70 what?
million returns. So
So 6x.
return on investment.
6x return on my investment. So in that case, I'd be roughly at a 1.5x my fund, 50% return. Yeah?
I'd say if you want them to invest in your fund, you want to at least give them a 2x return. So you need like a 10 to 12x return on that last company.
Yeah, right? Minimum, I need at least 10x so that I can get to a 2x return, right? Because I'm risky as a fund, right? My investors, they could just invest in the S&P 500 and call it good, right? So that means they got to generate a better return than what they could get in the S&P, and it's got to be not just marginally better, it's got to be a lot better, right? The other thing about these funds is that if I'm an investor in a venture fund, these funds last for 10 years, minimum. So what that means is I commit to the fund, I'm going to give you $100 million, and it's going to take that fund 10 years to send that money back to me, plus any profits, right? So my money is locked up in this illiquid asset, right? So it's illiquid, takes a long time, it's super risky because like 40% are just straight write-offs, right? So I better be able to have a shot at generating at least 2 times my money. Most funds shoot for 3 to 5 times their fund size. So all of a sudden, if I go, I need 10x on that one investment in order to get to a 2x on my fund. If I want to return 3x, now I'm at 20x on that one investment. And if I want to return 5 times my fund, right, now I'm like 50x on that one investment. But guess what? Here's the good thing, is just like we showed on our prior slide, 50x is actually possible. It's within the realm of possibility, right? Now, it's not likely, but it's within the realm of possibility. And so your job as a venture capitalist is every single deal you do has to have the potential of returning at least 10x, but probably more realistically, 20 or 30x the investment. Does that make sense? Otherwise, the math is just not going to work. And what ends up happening is VCs make incredibly risky investments, which is why 40% at least are just complete write-offs. Because they're that risky, right? But if they can make it, they can make it really big. All right, so every deal needs to have the potential of returning at least 10x. And if you are super lucky and you make it into a Google or a Facebook or an Uber, those investments for their seed and Series A investors returned 1,000 plus X. So they didn't just return 3 or 4 or 5 times their fund. In some cases, they returned like 25 times their fund on one investment of probably 30-ish investments in the underlying portfolio, which is pretty impressive. And you can, a lot of this data is actually public because a lot of venture funds take money from public pension funds like CalPERS, and they publish a lot of their returns data for these funds. So you can actually kind of look it up. You can see what Excel made on that fund that they invested in Facebook, for example. All right, so what does that mean? So we need a company that can get really big. Basically, what you need is a company that can become a monopoly. So like Facebook, Google, Uber, you name the company that's big, Apple, like they are all to a certain extent monopolies in their given market. So you need a company that can become a monopoly and that can scale very, very fast, right? You've only got 5 to 10 years for this thing to go from 0 to billions of dollars in value, right? So they've got to be able to scale incredibly fast. And they need to be able to dominate. Why does it matter if you're a monopoly? Can't I just get really big really fast? Isn't that good enough? Yeah.
Well, there's competition, so that would make it much more difficult to actually receive returns, right? Because even though Uber would merge, it goes also Lyft.
Yep. Yep. And why is Uber and Lyft kind of struggling right now in the public markets?
And I don't know the exact reason, but like I know in England right now there's a lot of law against the drivers, them taking the taxi market.
So at a fundamental level, the reason why Uber and Lyft are struggling relative to other tech companies that have gone out, that have been really successful at the same scale as Uber has, is because Uber is not profitable, and they don't have a highly profitable business model, right? Not like Google does, not like Facebook does, not like a bunch of these software companies do. You need a monopoly because you need to be able to have pricing power, which gives you margin, gives you gross margins, right? Gives you the ability to charge a high price and capture a lot of the value that you've created, right? And when you do that, then you can be valued very highly. So there are lots of companies out there that generate billions or hundreds of billions of dollars in revenue, but are actually valued less than 1 times their revenue. And that's because their margin that they make on each dollar of revenue is really small. And their underlying profits then that come out of the business, the stuff that you can take and put in your pocket and go to the store and buy something with, are really small. And that's ultimately all investors care about, is how much profit can I take out of this business? And right now, public investors are really questioning whether or not Uber will ever generate massive profits for them in the same way that other companies of a similar size and scale have generated, right? That's why monopoly matters. You need to invest in a company that someday could establish itself as a monopoly so that it'll have high margins and hopefully generate huge profits, and other investors will see that and be willing to pay a premium for that asset, right? So it's not just revenue growth, it's also valuation growth and profit and potential profits. So you're going to go out, hopefully starting tonight, and start sourcing deals. Start looking at deals. What are you going to look for? Well, this isn't all the things you should look for. These are some of the things that could be helpful. So 1, can it scale super fast? Why is software a great example of something that scales really fast? Yes?
Low cost of selling good.
Say that again?
Low cost of selling good.
Yeah, so I write the software once, and every time I sell it, it doesn't incur much additional cost in order for me to sell one more unit, right? Because I already wrote it once. And so I can sell it to as many people as I want. It doesn't really cost me anything more, right? It's very scalable. Versus if I sell widgets, right? Every time I sell a widget, there's a cost. There's a cost of goods tied to that widget. And I got to come up with that cash in order to buy that good and have it manufactured and marketed and distributed and delivered and everything else, right? So it's not as scalable. Strong team. Do they have a strong team? Do they have a good leader, and are they experienced? A lot of people look at startups and they're like, oh man, like, you don't really need that good of a team. Like, look at Mark Zuckerberg. Like, he was like a dropout from college. Here's the reality. Most of the time, companies that are the most successful and probably less, hyped, have teams that are very experienced. They've been doing it. Typically, like what we look for, what I like to see when I'm evaluating a company, I want to see somebody that's like worked in industry for a few years at least, and has identified a problem that they have felt the pain personally, day in, day out, and they know intimately. And they've decided, hey, look, I'm not the only one that suffers from this pain. There are all these other people that suffer from the same pain, and I'm going to build a product to solve that pain, right? And I know exactly how to build it. I know exactly who's going to buy it. I know exactly how much they're going to pay for it. I know exactly what the right way to position it in the market is, who to sell it to, all of those things, right? Like that is a really interesting entrepreneur, right? Now you can also have visionaries like a Mark Zuckerberg, right? That they kind of get it right on that first shot. But that's a lot more risky, and you just don't know, right? Operates in a huge potential market. So I say potential market because it doesn't mean the market's huge today, but it's got to have the potential to become huge in the future, right? When Uber first raised their seed round, I remember it, and I was like scratching my head. I was like, why are people so excited about Uber? Like, the taxi industry is a disaster. It's highly regulated, and by the way, it's small. It's only $11 billion in size, which sounds big, except for when you add on the fact that it's heavily regulated and heavily fragmented. I don't get it, right? It just doesn't seem like that big of an opportunity. What I wasn't fully paying attention to, though, admittedly, was that Uber's market is not the taxi market. Uber's market is transportation, which is a $1.2 trillion market, right? And they've effectively grown what was the taxi market from 11 billion to at least $100 billion in size through their innovative approach. So it's got to have a huge potential market, right? If you want your company to be worth billions, it better be operating in a market that's the size of billions. It should have some sort of unfair advantage over competitors. So that could be it's got unique patents and technology. It could be it has a unique team. It could be that it has unique network effects. It could have a unique distribution strategy. But it better have something that gives them an unfair advantage relative to the competition. I'll give you an example. We're an investor in a company called Fair. Fair.com. Fair is totally changing how you buy a car. So the way it works is they have an app. You open up the app, you take a picture of your driver's license, you sign a form, and then they show you all the cars that they'll underwrite for you. You pick the car you like, they deliver it to you. You can drive it for 3 days if you like it. Your payments kick in. And then whenever you're tired of it, you call them up and you say, hey, I'm done with this. And they come get it and they take it away. All at the price of less than what you pay the dealership for the car on a monthly basis. And it includes all your insurance and everything else. Okay, so that's what they do. Kind of interesting, right? What's their unfair advantage? Their unfair advantage is, in my opinion, two things, but both related to the management team. One is Scott Painter, who is probably one of the best fundraisers I've ever met. Why is that important? That's important because they're buying cars, which means they have to be able to raise billions of dollars, actually hundreds of billions of dollars, in order to finance all of that. So their unfair advantage is they've got somebody that's amazing when it comes to fundraising and sets them apart, right? None of their competition has a Scott Painter. Therefore, they're not able to raise the same amount of money. Therefore, they're not able to compete at the same scale as Fair.com is. Their other core advantage is they have the co-founder with Scott is the guy that built Tesla leasing, Mercedes, and ran Mercedes and BMW leasing. So he knows how to underwrite cars and their depreciation schedules, because that's the other big thing. And so he's assembled the best in the world at doing that, and that's given them also an unfair advantage when it comes to a pricing and buying and selling the cars on the back end of the service. So you should be looking for something like that, right? Could be management team driven, could be product driven, could be distribution channel, could be whatever, but it's got to have something in it that's unique. And then the last thing is it's got to be able to create liquidity in the next 5 to 10 years. So it's basically got to be able to be acquired or go public. Here's the thing. There are lots of great companies out there that are, they'll generate lots of revenue and lots of profits, but they're not really great venture deals. They'll just kind of take forever to get there. Or nobody will really want to buy them, and they're not really going to ever get to a scale and size that they could go public, right? Not going to invest in your buddy's corner store, right? Because it's just not scalable. It's not going to get that big, right? So you got to be thinking about that as well. Who would buy the company that you're going to invest in? Or do you think that they could get to a large enough scale that they could reason that they could go public? Go public today means you got to be doing about $100 million in revenue, and you better be growing it at least kind of 20 to 30% year over year. So they have to be able to reach that kind of scale. That doesn't mean, though, that you have to invest in a company that can reach that type of scale, because you could generate a great return on a company that gets acquired for $500 million, right? That's maybe doing less than that, right? But it's got to have something about it that makes it interesting to be acquired. I'll actually give you a good example of that, to hopefully make it a little more concrete. It's a company we looked at a number of years ago called Quanergy. Really cool technology. So they basically, how many of you are familiar with LiDAR? Anybody? Okay, this is what LiDAR does. It's super cool. It's used in a lot of self-driving car technology. It basically uses a laser, not just one laser, but like tens of thousands or hundreds of thousands of lasers. And those lasers shoot out and they measure down to like less than a millimeter distances between where the laser is shooting out and whatever it hits and comes back. And based on that, it creates these point clouds that can then be turned into 3D environments that are super, super, super accurate in terms of distances and so forth. The challenge is that they're really big and they're really expensive. And so what you'll see if you look up self-driving cars, you'll see like giant balls on the top of cars and they're spinning around. It's that laser, and what it's doing is it's shooting out the laser as it goes around. So Quanergy has this really cool technology where it's basically solid state, so it doesn't have to spin, and it's down to the size of a pack of baseball cards. That's what they do. So pretty interesting technology. If they get it out in the hands of lots of vehicle manufacturers, could they get really big? Yeah. Even if they don't, there's probably a lot of people that would be willing to buy that company for its technology, right? So that's hopefully a good example of a company that like very clearly could get acquired, or if their business is successful, they could go public, right? All right, so let's talk a little bit about VC funds. So I mentioned earlier, they're small partnerships. Typically, each partner finds and leads their own deals, and then they'll take the board seat on that deal. But the partners must convince each other to invest in their deal. And so if I'm a partner in a 5-partner partnership at a venture fund, right, my investment committee is my 4 other partners. So I will come to them. Usually what happens is every Monday morning at most funds is their partner meeting, and it could run all day or at least in the morning. And that's when everybody gets together and they talk about the deals they're working on, what they find interesting, and so they're kind of filling in their partners over time. And then eventually, like, comes down to like, okay, we want to do this deal, and so they'll do an investment committee, and that partner will come in with their, analysts and associates, and they'll make a pitch of like, here's the company, here's the investment, this is why we want to make it, here's our thesis behind it, et cetera, et cetera. And then as a partnership, they'll vote on whether or not to move forward. So that's what you get to do at the end of this. If you're selected to be one of the 5 finalist teams, is to prepare your stuff as though you were one of those partners pitching to the other partners on whether or not to. All right, so just some guidance on where to look for your deals. As long as you can get reliable data, I don't care where the deal comes from. Which means if you know somebody that has a really great startup and they're willing to share some of the data with you and they're okay with you sharing it with us, then by all means, that's awesome, that's great. But we make no promises of confidentiality here. We're not going to do that. But if you can't find that, here are a whole bunch of places you can go. Now, the thing is that was great under Obama is he passed this act that basically allows individuals that are not high net worth individuals to invest in startups. Because the way it normally works is you can only really invest in a private company if you are deemed to be a high net worth individual, which means that you're making at least $200,000, I think, a year, or your assets, excluding your primary residence, are over $1 million, which excludes the vast majority of people. So they came up with this law that said, hey, look, we're going to make it so that normal people that are not high net worth investors can invest in these startups. And when that happened, you had a whole bunch of startups and companies start that create marketplaces of startups that are raising capital. So Seed Invest, Start Engine, WeFunder, Fundable, Crowdfunder, a lot of those are really good for that. AngelList is really good. Circle Up is really good. Circle Up is mostly consumer products. AngelList has all kinds of stuff in there. It can be really interesting. Lots and lots of different technology startups. And these others. I'll also say that it doesn't have to be US based. It can be international based. So I will also admit though that the quality of company is probably not going to be incredibly high. So you're going to have to sift through a bunch of crappy companies. But like, guess what? That's par for the course anyways. Most VCs will look at 1,000 deals for every one that they do. But there are also great companies that have come out of here. So Oculus was a company that was crowdfunded before it got acquired for like $2 billion by Facebook. So there is good stuff out there. And then I guess the other thing that I'll say is that we will, if you're like, hey, look, I think there's a really interesting opportunity in this sector, and this is the best startup I could find with reliable information in that sector, and then you do really good due diligence on it, we're gonna take that into consideration if we know that, yeah, in fact, there's this other company that's even better, but you didn't have access to them. Does that make sense? So focus more on doing good due diligence, finding opportunities that are really interesting, business models that are really interesting. It doesn't actually have to be the next Facebook or Google in order to win the competition. All right. And I think that kind of brings me to the end. So just a reminder, the next workshop's on the 23rd, so next week. It's up at USU. We will be recording it. Your team members and team name are due on the 23rd, so also you have basically a week to get that done. It's also the last time to sign up. And then start looking at your top 3 companies because you basically have a couple weeks to get that done. And I'm going to go back to this page in case anybody wants to see it. Any questions? Yeah.
Where will the recording be posted?
On our website.
Okay.
Which is ugrowthfund.com/VC-competition. Yeah.
Where's the best place to find reliable financials? Be on these websites?
Yep, on these websites. Yep. Yeah, you can assume that if they present it, that it's accurate, which may or may not be the case. It's reliable enough. What's not reliable is my cousin Joe, he's got this cool startup, and he says they're doing this. But I can't verify it in any sort of way, right?
So ideally it's something that's posted online for the public.
Yeah. Or if cousin Joe actually sends you their financials, and you could be like, oh, here's the financials you sent me, then that's verifiable, right?
And how much detail in financials is revenue?
Whatever you think is going to be sufficient for you to make a good investment decision. But you don't have to show how much they spent on toilet paper that month.